Now, I'm pleased to introduce you to our first speaker, Amin Joseph Barakat, Vice President of GLC Asset Management Group. Amin is responsible for managing GLC Asset Management Group's relationships with distribution networks. His focus is on communicating portfolio strategy and positioning within the investment mandates across GLC's 5 investment divisions, as well as providing insights into current market and economic conditions. Amin brings over 15 years of industry experience to his role. Having worked overseas, as well as in Canada, he incorporates a global perspective in providing appropriate context to dynamic market conditions that has been valued by diverse audiences, including investors, advisors, and international private bankers. Amin earned an HBA from the University of Toronto and an MBA from Queen's University. Amin also holds the Chartered Investment Manager and FCSI designations. Amin?
Good evening, everybody. It's a great honor to be here. I also want to extend my sincere thanks for having me be a part of the event. It's a terrific turnout and a fantastic evening in terms of the dinner. Hopefully you'll have some interesting insights from my presentation. So, wanted to pick a title that kind of felt thematic with the way things have been of late in markets. We've seen some volatility of late. We don't think that that's something to be overly concerned about. It's actually something that we consider to be healthy at this stage of the market cycle. As you can see on the screen here, you can see returns across various indices across the globe. Generally speaking, for risk assets, equities, we've seen a large swing towards the negative side. Much of that, I would point out, happened in October. So, for example, the Canadian equity market was down about 6.5%. The US market was down around 7%. And if we look at emerging markets, we'd seen a 9% decline just in the month of October. So a large chunk of what we see in terms of negative pullback happened during the month of October. And for some extra perspective, the week after I took the snapshot, we had seen the emerging markets index improve by 6%. That's 1 week return, 6%. The Japanese market, the Nikkei 225, went up by 5%. And the S&P 500, the US equity market, was up by more than 2%. So these swings, they're short-term, and they can be pretty drastic over that period of time. What we tend to urge people to do is make sure they take this somewhat with a grain of salt, keep focused on their plans, and recognize that if we take a look at performance right across the spectrum, having diversification within a portfolio means you're not exposed to the moves in any one specific direction from one particular market. So the bond market is the top figure there, which is close to flat. So for people that tend to have some fixed income in their assets, that really helped to cushion some of the impact from the equity market volatility we've seen. So what's the cause for this volatility? Well, in actual reality, many of the things that we have seen that came up to light in the media in October have been issues that we've been grappling with for much of this year. The thing is, markets tend to focus on different things at different points in time across the cycle. So some of the challenges happen to be growth-related. If you think about growth, we're talking about GDP or economic growth. That's what ultimately will drive corporate earnings growth, which tends to drive share prices. So we've had some questions on the outlook for economic growth. What we generally see is continued economic expansion going through to 2019. The key challenge at this stage is that we're not seeing the kind of synchronous growth that we were seeing about a year ago, meaning all regions of the world were expanding at roughly the same pace, experiencing the same degree of success in self-sustaining economic expansion. Now we're seeing different regions operating at different speeds, so to speak. China is going through a bit of a slowdown. Of course, if we take a look at it regionally, it's still got one of the best growth rates across the globe. But that remains a bit of a question because we've got challenges like high debt levels in China at the government level, and we've got trade issues. Probably everyone sees Twitter or news feeds that come out with Donald Trump's discussions of how harsh they want to be in terms of their trade relationships with China. These things are weighing because China is export-oriented from its economic perspective. But in North America, we're seeing signs of late-stage economic expansion, which is a good thing. What we're really talking about when we say late stage is we're having low levels of unemployment. We're starting to see further wage gains or wage growth, and we're starting to see a path towards normalization in interest rates. So interest rates starting to move a little bit higher. Those are good things if we want to see a self-sustaining economy. In Europe, we've got some questions there. We're seeing some political risks ebb, but at the same time, there are other political risks that are out there in the marketplace as well. For example, Italy's budget was rejected at the Brussels level. We've got challenges negotiating Brexit. But at the same time, we are seeing economic growth without high risks of inflation at that point as well. So there are positives and negatives throughout the system, but generally speaking, what we would want to emphasize is the economy continues to grow, and that typically bodes well for earnings at the corporate level. The other challenge that we've seen markets grapple with, particularly in the last few weeks, has been interest rates. So how high we're going to go, how fast we're going to get to that level. Well, the reality is no one really knows what the new normal is for policy rates at the federal or central bank level. We've come off of a significant period of monetary stimulus. But what we would suggest is when we tend to see articles about interest rates going up, having drastic impacts on households, on businesses, this chart should explain things in a little bit more broader perspective. When we look at interest rates, typically what they're designed to do is target inflation. Okay? And if we look here, inflation doesn't look like it is somehow getting overly aggressive or ahead of itself. And so we feel at the policy level, central banks don't have to be overly aggressive in their pace of interest rate tightening. So those have been the two key things that drove markets a little bit lower. As bond yields rise, that tends to put pressure on stocks. And we had seen a lot of that happen in the last several weeks. And so that's been playing out a little bit in the equity markets. So taking a look at things from the equity asset class perspective, I mentioned we've seen an equity market pullback generally across regions. We continue to see earnings growth. So how we look at this context is the recent pullback has actually made valuations a little bit more attractive. If you're a long-term investor, and if you're investing in equities, by definition you really should be, what we tend to look at this is at least adding a little bit more of a constructive view on the equity asset class. And we would look at that and urge that people don't react on a knee-jerk basis to what we see in swings on a one-week, two-week, or month-to-month basis. One of the key things that we look at are fundamentals when we're looking to invest in equities. And one of the fundamentals that we look at is how much we are paying in price for every dollar of earnings in the marketplace. So what we're seeing here is, generally speaking, current valuations across equity markets relative to their historical averages going back over the past decade. As you can see, nothing screams out as overly cheap, but at the same time, if we look at valuations where they were at the end of last year or the beginning of 2018, valuations have pulled back pretty meaningfully across most markets over this past year. So as I said before, while there is this volatility and there are some uncertainties in how the economic picture may unfold, at the same time, we would be more constructive on the valuations of equities now than we would have been a few months ago. Looking at relative comparisons, one of the things that we want to make sure we have an understanding of is what is the path of earnings growth, the outlook, both for the end of this year and through 2019. Now, this is, of course, forecasts, and they're subject to change. We generally will change that as we see economic data come in, as we see corporate performance come through on a quarterly basis as they report results. But what we can see here is, generally speaking, across regions, we have earnings growth. That's positive earnings growth, right? And we continue to see that through 2019. Over the long term, it's earnings that drive share prices, not anything else like geopolitical tensions in one place or another. It's about whether or not companies are profitable and using their capital judiciously and profitably. What gives me a little bit of comfort here is, while these are forecasts, at the same time, the forecasts are generally high single digits to low double digits in earnings growth over the course of 2019. We do think those are a little bit optimistic in the current environment where interest rates are starting to move up. We're starting to see capacity constraints. And so we would naturally expect some of those revisions to come down. But we're not looking at outright negative or contracting earnings. It would be just growing at a lower level. So if we think about this, the pullback in equity markets, valuations have become a little bit cheaper, and we continue to see earnings growth, that provides support to that component of an asset class or an asset mix in your portfolio. Looking at things on a relative basis in equity markets, one of the key things that we tend to look at here in Canada is comparing how we are compared to the United States. Well, if we think about it in those terms, the flat line on this chart indicates historical averages of the equity market in Canada and the US, their average PE ratios on a forward earnings basis. And when we take a look at the green and blue zigzag lines, what we can see is how they compare to those averages. Now, the US market, representative of the US economy, has been fairly rocking and rolling over the past few years, right? Particularly as we've had additional stimulus through business tax cuts, personal tax cuts that the Trump administration ushered in upon election. Their valuations are trading at a bit of a premium relative to both their historical averages and when we compare US equities to Canadian equities. Importantly, that valuation gap that we see right now, if we go back over the past decade, the gap between Canadian and US equities in terms of their valuations is quite large, among the largest we have seen going back to about 2008. So if we are looking and saying, you know what, Canadian equities, they've been a bit of a drag, it's been some time that we've been lagging US equities or other counterparts, yes, we wouldn't argue that point. But if you're a long-term investor, we wouldn't say this is the time to say, I don't want to have any more of my Canadian equity exposure. In fact, given that it's cheaper and you can get some extra diversification across different resource sectors and our strong financial sector, if it's cheaper now relative to historical terms, that provides an attractive entry point for a long-term investor. We're not arguing not to have your US exposure, but to recognize that there are relative differences in terms of valuations, and we tend to see higher volatility in more expensive assets in late stages of the economic and market cycle. Taking that one step further, we would also look beyond just the US and Canada, but how the rest of the world might look. And we always advocate global exposure in a broadly diversified portfolio. One thing that we would look at here, taking a look at European equities as they compare to the US. And again, similar to comparing US equities to Canada, the US equities trade at a premium in terms of price to forward earnings. As I mentioned, stronger economy, they've been growing earnings more solidly, people have been willing to pay a premium to get that higher rate of earnings growth and therefore higher rate of share price appreciation potential. Now, there are risks investing in all markets, and if we look at the European market, one of those challenges, as I mentioned, you've got some of this political uncertainty and the rate of growth and towards interest rate increases over time. They're growing at a slower rate, but we are seeing signs of stability there. One of the key challenges will continue to be that political side. And no one can really forecast what the outcomes are there. But we do think with the discount of European equities to US equities, at some point around these levels, it starts to price in some of that uncertainty. And again, when you add the sector diversification that you can get, the access to unique companies operating in different markets, we think there's value there for a long-term investor to maintain that global approach to investing. Talking about fixed income, that other important part of an investment portfolio. Overall, what I would say to you, if I were going to give it a very quick summary, is it's going to be a bit of a headwind in fixed income. Interest rates going up puts pressure on bond prices, which means it puts pressure on performance. So we would definitely not suggest to you that this is a period of time where you should expect rip-roaring returns in the bond side of your investment portfolio. But what we would strongly advocate for is that fixed income, as a part of a diversified portfolio, serves to act as a strong risk mitigation tool in any given market environment. But here especially, as we get towards a late stage of the economic and market cycle, we start to see a pickup in volatility. Fixed income can be a strong ability to mitigate when you have that increased level of volatility in equities. So that's how we need to look at it. It's not solely as a return opportunity, but as a risk management opportunity within a portfolio. And that's what we would really want people to take as a message. So where that pressure has been coming from in fixed income has really been from markets starting to price in rising interest rates, okay? And how do they price that in? It tends to reflect in bond prices moving a little bit lower and the yields of bonds moving in the opposite direction, higher. So in this chart, we can see how Government of Canada bond yields have been moving over the past several years. What I would highlight is really since about middle of 2016, as we've seen these economies become much more self-sustaining, starting to see more stronger job growth, more stronger business investment, and better results at the corporate level, we've started to see an expectation of a move towards more normal interest rates. In other words, a move from close to zero at the policy level of interest rates to a level somewhat higher than that. The Bank of Canada currently calls a neutral rate somewhere between 2.5% and 3% at its level. And we're looking at around 1.7% at the Bank of Canada right now. So their ultimate long-term goal would be a few interest rate hikes higher than this. The question is, over what period of time we would see that? So with bonds starting to reflect that positive improvement in the economy, that's put that pressure on the fixed income side of an investor's portfolio. So what do we do about this? Well, just like investing in the equity market, this becomes a relative risk-reward opportunity. And currently, how we look at fixed income is the ability to mitigate against those rising interest rates by having a little bit of a yield pickup. And where we find a yield pickup, in other words, a bit higher yields than what we would find in government bonds, which would be the lowest risk and therefore lowest yielding bonds, where we would look would be in corporate bonds. So you can see here, we start to see a chart across different levels or credit qualities in fixed income. The lower the quality of fixed income, the higher the yield. In other words, the issuer of that lower quality fixed income product needs to pay you a premium in order to justify why you would invest in the higher risk bond, right? We think there are opportunities in higher quality fixed income corporate bonds as a way to help mitigate against the issue of rising interest rates weighing down on bond prices. And this is where we would tend to be more constructive in the asset mix. So I've given you a little bit of a perspective on equities, on fixed income, and the broader macro picture. But the reality of the situation still comes down to what does this mean for me as an individual, as an individual investor? And how we would look at this is really to make sure that we keep things into context, which is for you to focus on what is relevant for your specific plan and your goals and objectives. Maintain a long-term perspective. Don't let the news cycle dominate how one feels. Now, I know you work with an excellent team, but the vast majority of people tend to be consumed by what is out there in social media and news media, etc. And it can become emotional. So these are the reasons why we tend to have some of these messages whenever we have a chance to engage in an audience. I know Mike and his company takes excellent care of you, and these are things that are already well embedded from a perspective, but nonetheless, they're important messages for a broader investing market in Canada. So when we think about strategies in the context of late market equity investing, what we tend to think about is, first, what does your plan look like? So you're revisiting your asset allocation strategy. If, for example, over the course of the last several years, equity markets that have gained quite a lot in value might have skewed the equity side of a portfolio to a level that's a little bit higher in exposure than you would normally have relative to your risk, this would be a good time to be revisiting that and doing some rebalancing. Taking a little bit of profit off the table in areas where you've made more money and gaining exposure to areas where we've seen a pullback. The same way as when there's an equity market pullback, a long-term investor might think, well, if nothing has changed for me personally and I still have this time horizon and I still need this money to deliver in this way, then I look at these pullbacks as an opportunity. It should be like that across all asset classes, and that's what rebalancing would do in a portfolio. The other key thing is to make sure at this stage no one's looking at chasing the latest trend for hot performer. Basically looking at what has performed well already and assuming that that performance can be extrapolated into the future. That is typically not the case, and very often we tend to see examples of that where people mix up investing with speculation. A great example would be about a year ago this month, perhaps it was a little later November, early December, I was out in an audience of financial professionals, and they asked me a bunch of questions on Bitcoin. And I had been asked several times up to that point in the year, and it had almost become the bane of my existence, actually, answering questions on it. Because it wasn't an asset class that we could value, we could measure. It didn't produce any earnings, didn't produce any dividends, so it really became a price speculation. Where do we think Bitcoin is going in value? And it was the trend. 6 months later, I haven't had anybody ask me anything about Bitcoin. So you wonder how many of these people might have gotten severely involved in something like that, deviated from their investment plan at the risks of something like that, which is a speculative asset rather than a long-term investment asset. It happens in every market cycle. I give you Bitcoin because it's one of the most recent ones. That's pretty high profile, is one that has shot up through the roof and has recently quietly pulled back without very much fanfare. The last thing that I would suggest is what we tend to look at as money managers, a look to upgrade your portfolio in terms of quality. And what I mean by quality is things that we can quantify, things that are somewhat tangible. So these would be, if we're looking at equities, companies that have solid balance sheets, so asset liability mix is attractive, the ability to have resilient earnings in both good times and bad, that they have a track record, that they have weathered through previous economic difficulty and come through shining on the other end of it. That would be the kinds of things that we look at from the equity side. And of course, valuations are important. We don't believe in overpaying for something just because it has a good story. In the end, those are the companies that tend to be more vulnerable. From the fixed income side, as I mentioned, what we would look at is a good mix of high-quality corporate bonds and complement that with some lower-risk government bonds, if you will, as well. But these are the kinds of things that we tend to look at. High-quality corporate bonds as opposed to high-yield corporate bonds, which are more of the higher-risk side of the fixed income space. So when you're upgrading to quality, those are the kinds of things that we tend to think about. It should always be a core part of the portfolio, but as we've moved through a cycle over years, sometimes things get added into a portfolio. We don't notice as much when performance is positive. This is a chance for us, while we've got this stage in the market, we haven't suffered substantial downturns, to take a look and say, well, if we've made profits in areas that we don't think are as attractive in terms of quality, maybe now's a chance to restructure that. One of the key things that we can look at and quantify quality with would be blue chip stocks, typically dividend-paying stocks. I'm not talking about dividend-paying stocks as a strategy that works just for this point in the market, and you have to figure out when is the time not to own them. Dividend-paying stocks have a long-term track record of delivering solid risk-adjusted returns. What I mean by that, if we take a look at long-term track records, this chart here shows two results. The price appreciation of the Canadian equity market, just price appreciation, and what the same market, same stocks, would have done if you factored in dividends and reinvested them. I'll put it into numbers for you. If we take the 20-year performance, if someone had put $100,000 into the Canadian market 20 years ago, on a price return basis only, those stocks would have generated a portfolio size of $260,000. Okay, so 100,000 grows to 260,000. That same 100,000, factoring in dividends being reinvested, grows to $416,000. You haven't done anything else but simply hold the money and let the dividends reinvest. That's a 60% difference in the size of the portfolio. We think that's compelling. right? Hopefully you feel the same way. And as I said, this is an enduring strategy that becomes more valuable as we enter late stages of a market. I wouldn't advocate only looking at it from the Canadian perspective. As well, there are quality dividend investing opportunities around the world. This chart just gives you a bit of an idea of why it pays to invest outside of Canada. We're a narrow market. We're fairly concentrated. What we have in terms of dividend-paying stocks are great, but we would also suggest having exposure to sectors that we don't have a lot of good things in from a dividend perspective. In information technology, we don't have a lot of dividend-paying stocks. We don't have a lot of stocks in the information technology space, to be honest. In healthcare, for example, we don't have a lot of opportunities to invest in dividend-paying stocks. So these are some of the reasons that one can look at and find high-quality dividend-paying stocks outside of our own market. So you get the diversification and that same benefit of what kind of quality investing can drive in a portfolio. A couple of things that I want to make sure I get across as well. From an investing standpoint, when we talk about investing, in our industry, we tend to talk a lot about averages, right? Averages mask a lot of underlying performance from one year to the next. One of the key things that we think about is, what do you expect as a long-term rate of return in markets? Very often, I have this discussion on a personal basis with friends, relatives. They know what I do for a living. So what do you think is a reasonable rate of return? Very often, we tend to find agreements somewhere in that 7, 8, 9%. That's at the upper bound of what we look at for equity market returns. But as food for thought, if we look at it on a calendar year basis, going back over the past 34 years, only 24% of the time have we actually had, on a calendar year basis, a return that falls somewhere between 6 and 12%, what we would classify as a range that could be considered normal based on a variety of opinions. It's a quarter of the time. In fact, more often in a calendar year have we had negative returns than normal returns. So when we talk these averages, we have to be willing to go through different experiences from one year to the next. And the reason why? Well, a bulk of the time, more than 2/3, our returns are positive. And in fact, it is more often that we have outsized, stronger returns than we have normal returns. From a psychological perspective, these swings from one year to the next that can happen, they may not feel great, but they are a necessary part for the course in order to attain long-term success. And the best investors in the world know this. They say it all the time. The challenge is whether or not we as individuals have the discipline to see that strategy through. And as my title said, that discipline truly does pay dividends, literally and figuratively. Talking about how we can experience ups and downs in markets, I wanted to present a few experiences going back over the decades. We've got around 16 setbacks here, a range of things, whether we consider political assassination, wars, financial crises, investment downgrades of sovereign credit. There's a variety out there. The market has experienced all of these, and for those that have had the ability to maintain a longer-term perspective, what has happened is the markets have seen these through and come out on the other end successfully. In every single one of these incidents, what we tend to see is, on average, after 1 to 2 years, a much stronger market than it was at the abyss of whatever the setback is. And on average, what we tend to see is quite significant. These market setbacks, if we aggregate them, roughly a 20% decline if we go from the first to the last. And on average, those appreciations after 1 and 2 years ranging somewhere between 30% and 45%. We don't say that these things are going to happen just like this. The average is an average. It covers a lot of experience. The key points from this is we have been in difficult periods before, and we will be in difficult periods again in the future. No one knows when they will come, but as we have in the past, earnings are what drive share prices. And as long as the economy has the ingredients in there, the ability to innovate, the ability to expand, we will see through whatever setbacks there will be. We just need the time and the patience to be able to see through the other side. One key point I wanted to point out in terms of diversification, comparing asset classes, that is the only free lunch in investing. When we look to mitigate against risk, the best way to do it is to have very different correlations in asset classes. So here I want to show performance going back to 2000 across a range of setbacks in the Canadian equity market. Now the pullbacks constitute anywhere from a 20% drop to around a 50% drop. Okay? Garden variety bear market pullbacks. If we were to compare now, I know some of you in the back may not be able to see the numbers, which is good for me because I can make up whatever I want and no one can know the difference. But in truth, what we would tend to say is if you had diversification across asset classes, so looking at the Canadian equity market, well, if you had some Canadian bonds in there, how would things have fared out in each of those same time periods? Quite generally speaking, you had positive performance right across each of those equity market declines. So what happens is the power of that blend, whatever the blend is, it's appropriate to your own risk profiles, that is the ultimate mitigator of equity market risk. In 2008, I remember a lot of discussions that would come out from average investors that I would talk to. They would say, I thought I was diversified. And I would have it as a casual discussion. Well, out of curiosity, what did you have? Well, I had emerging market stocks, I had US stocks, I had European stocks, of course I had my Canadian stocks. I said, yes, it's true, you were diversified across the equity spectrum in your portfolio, but you only have equities. Equities are a risk asset class, and it was a risk-off environment during the financial crisis. So if you were looking for protection at that point, you certainly wouldn't have found it in emerging market equities where people were fleeing Canadian market equities. And they weren't fleeing European equities to say, hey, the safe place is US equities. In fact, the financial crisis's epicenter was in the United States. So what tends to save that is the asset class diversification. And the mix there is really relevant to the individual investor at that point. But to show the value of it, we think that that's compelling. Another issue that I want to make sure people understand, we talked about the ups and downs in terms of calendar year performance. We've got more negative performance than we do normal years. Absolutely. Where the averages make things compelling is because they talk about a long-term experience. And this slide hopefully articulates that a little bit more succinctly. Over time, bull markets outlast bear markets in duration and the magnitude of performance. So when we look at this, it goes back to 1942 on the S&P 500. What you can see is the average bull market or expansion, 20% plus, and the average bear market, 20% or worse. So we see the average bear market going back over those decades is about 35%. The average bull market, about 165%. So pretty significant differences. And again, for those that have that patience, we think it does pay to stay invested. I want to close off with just a few words that I thought would be relevant given the context that we're speaking here together in. One, investing shouldn't feel comfortable. It really shouldn't. In fact, some of the best decisions are the ones that don't feel like you're doing the right thing in the moment. It's usually with the benefit of hindsight, sometimes far out into the future, and sometimes could be a year or two, where we look and say, yes, that was the right decision. It was a unique opportunity. I'm glad we took advantage of it. That is typically what investing is. If investing gave you a sense of euphoria each time you made a decision, well, everybody would be doing it. No one would struggle. The world would live happily ever after every single day the market opened and closed. Nothing works that way, right? The other key thing that I think is of extreme value, and I think that you all benefit tremendously from here through Langlois Financial, is really that the benefit of professional advice increases substantially as uncertainty increases. There are so many investors out there in the world that may think they know as much as they should know about investing. And when markets are doing well, there may be a false sense of security that we are in fact doing the right thing for ourselves, handling our own affairs. But this is an extremely important balance between emotions and rational thinking. And I do truly believe that the benefit of having a professional or a team of professionals behind you is that ability to remove the dynamic of the emotional component and incorporate objectivity and the ability to refocus on what it is that is appropriate for you, that helps you stick with your plan in difficult times, but excel over the long term. Folks, I hope this information has been insightful. I want to thank you for your time. Again, thank you, Mike and company, for having me be here tonight. And I'll wish you the best for the rest of the evening.